So we've had a nice run in the market, and with this recent pullback, I've had a lot of people starting to ask questions about, hey, is this the top? Is it rolling over? So we're going to dive into that today. My name is Brian Cannon, and welcome to Markets in 5. All right, let's jump right into the S&P 500. So we've got two of our main indicators I keep talking about. RSI, when it drops below 50, is a warning sign. But then when you combine a negative, under 50 reading on the RSI with a negative reading on the MACD, the two of those are pretty powerful. So, we over the last couple of days have just gotten that, and the market's been real kind of punchy here. So it came all the way down, did find some support on the 100-day moving average. I had put out a market update last week on our blog and put some of these arrows in and said we were looking at some of these levels. One of the levels we're looking at is the peak from the end of 21. Would be a very natural place for the market to come down and find support. And if it holds that and bounces up, that means it kind of holds its breakout and continues on. But I did highlight this area right here, the 100-day moving average. It did come down, bounce off that, and head up. But again, until we get a RSI reading above 50 and a MACD back positive, we're still kind of in the woods. All right, this is kind of an interesting chart. This is the 40-week average of the S&P 500. And so the goal is to try to knock out some of the noise, knock out some of the volatility, and prevent you from getting whipsawed in and out of trades. So if you look back historically, when the 40-week average is above both of its 20 and 40 average lines, then it's usually in pretty good shape. So you can see when it drops below the red and blue line, then the market really does struggle, and that coincides with an RSI, funny enough, on the 40-week average dropping below 50, and that's combined with the MACD going negative as well. So it really does work. And so where are we now? What is this saying? This is saying that we came down and we touched on the 20-week moving average. And so that's not a bad thing. So what does that tell us about the market? It means that it might hold this level, and if it does, then the party's still on, right? You don't want to necessarily get out of positions. However, if we see this 40-week average drop below this line and really start to head and certainly break down below the 40-week average, then then that's going to be trouble. We do have a crossover here on the MACD, although it is positive. And we are above 50 on the RSI. So again, this particular chart is not flashing a warning sign yet, but it is certainly coming off of an overbought reading up here. So it certainly does have the potential to drop down. So we're watching this very, very closely, but I would say this chart would be maybe a vote on the other side that maybe we would hang in there a little bit longer. All right, I'm going to walk through two more charts. This is more longer term views, but if we look historically, I've been kind of beating the drum on this. The market goes through periods of secular bear markets and secular bull markets, and so we're definitely in a secular bull market right here. And secular bear basically means you haven't had a higher high, and so it just kind of consolidates and goes sideways. There's lots of volatility, goes up and down, but really the market doesn't advance and break out to a new high. So we are at an all-time high right now. But if you look back to the 70s and 80s when we struggled with inflation and stagflation, and the market basically went sideways for the better part of 13 years. It did actually break up, make a high, a little bit higher high, but then it broke back down. Couldn't hold it, and it wasn't till 13 years later where it actually broke out. So the thing is, you don't know you're in a secular bear market until you look backwards. And so we may be in one, but what's interesting here is we've never had a secular bear market without inflation, and we've never had inflation without a secular bear market until right now. So are we in the midst of a bear market? It's too early to call. You have no idea, but I'm just saying that we've never had a secular bear market without inflation. All right, when you combine that last chart with this chart, they really do start to tell a story. This is a story of the yield curve inversion, so the 2-year relative to the 10-year Treasury yield. And when that drops down, the black line is the Treasury yield. When it drops below the 50 line, I'm sorry, below the red dotted line, that means it's negative, meaning we have an inverted yield curve. So when that inversion happens, then what we've seen over the last several is that the market begins to roll over. The Fed starts to lower rates to basically spawn more spending. So if they can lower the rates, you're going to buy houses, you're going to buy cars and boats. And so they're doing that to hedge off the risk of the market, which is on the tip of really sinking. And then you see unemployment rise here in the orange. And so the combination of these actions all occur prior to a recession. And it happened in 2000, it happened in 06, 07. With the U.S. recession. So, there was a very, very, very mild inversion. I didn't even bother covering it up here in COVID. We had a spike of unemployment, of course, and then, everybody realized everybody had a lot of money, and so they started, they couldn't hire fast enough. So here we are. We've got this nasty yield curve inversion right now. And so I would say we're watching for this market to when it rolls over, you're going to see this yield curve normalize. They're going to start bringing rates down, and you're going to see unemployment rise, and we're going to be in a recession. So is that 6 weeks away? Is that 6 months away? Is it a couple years away? Who knows, right? But all I know is that this is something we're watching very, very closely. So as you can see, there's definitely some signs out there that are flashing the warning signs. So, again, we don't know if this is going to be a small pullback or a large one, but at this point, it doesn't pay to put a lot of risk on at this point. Now, if it drops down a good bit, then certainly it would make more sense. But I would say just be a little bit careful right now and watch your levels. But if you have any questions, give me a shout, and I'll see you on the next Markets in 5.